Upstart, the artificial intelligence company that uses AI to make lending decisions, is scheduled to report quarterly financial results on February 11th, 2025. That has investors asking, should they buy Upstart stock before the company announces earnings or wait until after earnings, or should they buy this stock at all? That's the question I'll answer in this video. I'll also preview what investors should look out for from Upstart when it announces quarterly results. I'm going to go beyond the obvious and talk about critical factors that are not going to be reported in revenue or earnings per share figures, things that are important for the long run success of this company. So follow along and let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so in its latest quarter, Upstart reported total revenue of $162 million, which was up 20% from the same quarter last year and up 27% from the previous quarter. In all, 188,000 loans were originated for $1.6 billion across their platform. That was up 30% from the same time last year and up 43% from the previous quarter. So the big factor that's not mentioned here that's driving this increase is an increasing appetite from investors for these loans. Now, if you're not aware, Upstart aims to just be a platform that brings together lenders and borrowers, and Upstart is just a middleman in these transactions, offering its AI model for lending decisions. That's the service that it wants to offer, and it wants to make money from that service. It doesn't want to make money from making loans. That's risky, that's clunky, and that's more difficult to grow and scale. For Upstart, what's most lucrative is for them to develop that AI model. If they can develop that AI model to be at least comparable to traditional lending models, then the business for Upstart can grow exponentially. It can grow to a much larger magnitude than where it is today. The key is that AI model. How will it perform against traditional lending models? And it doesn't need to beat those traditional lending models. In fact, even if it can come close, it can gain considerable market share. Why do I say it doesn't need to beat it? Because using AI to make lending decisions is so much more cost effective than traditional lending models. That requires all of this paperwork to process these loan applications. People need to submit their pay stubs, their tax returns, their business income expense, etc., etc. The process, the paperwork back and forth could take, weeks, maybe even months to get loans approved. And during all of that processing, there's hours of labor that's put into it. And these are not low-wage people that are processing these paperworks, these loan applications. And so the costs are much higher the way things have been done with the traditional lending model. So if Upstart can innovate and deliver something with similar performance, its costs are so much lower using AI to make decisions. They can get to decisions much quicker without the need for the borrowers to submit all of that paperwork and all of the hassle that goes along with that. So that remains to be seen because Upstart has not been around long enough to gather enough data to come to that conclusion for lenders to trust that Upstart's model is actually equivalent to or close to the traditional lending model. But lenders right now are willing to give Upstart a chance. That's why you see the company growing as it is. That's why you see the company making these loans and selling it to these third parties that are agreeing to lend money utilizing this model because they're willing to test it out because they like the potential of the gains they can receive at its current rate. So the rates that lenders can receive on these loans right now as it stands, incorporating, of course, that risk that's embedded. And so those are the big things to look for from Upstart when it reports its quarterly results beyond these obvious numbers of revenue growth and income from operations. That's one of the factors. Another factor you want to hear about is the appetite from investors for these loans. That's what's driving the growth for Upstart, as I mentioned. And from the companies that I've evaluated already, most notably, I just reviewed SoFi, its earnings results. And from what I gathered from SoFi and its management team, the appetite from lenders for these types of loans, personal loans for the most part, is what Upstart originates. And SoFi has a big personal loan segment. So I draw a conclusion from those two. And the appetite from investors for SoFi's personal loans was off the charts. It was incredible, way better than what SoFi management thought. And so I'm making the connection and thinking and forecasting that Upstart will report something similar, that its buyers or its lenders on the platform increase their appetite for these loans, and that they will report a solid quarterly number, perhaps better than they were forecasted. Which, let's take a look at their forecast. For the upcoming quarter, the company is forecasting revenue of 180 million and adjusted EBITDA of approximately 5 million. The adjusted EBITDA number of 5 million would be a big increase from the previous quarter, where they reported just 1.4 million in adjusted EBITDA. The revenue number of 180 million would also be a solid increase from the previous quarter, where they reported revenue of 162 million, which was also a significant increase from the quarter before that. So they're getting nice increases in quarterly revenue as appetite for making these loans on its platform are increasing. So should you buy Upstart stock before earnings? Well, it's already trading at a relatively higher valuation. It's trading at a forward price to sales of 5.822. So I don't think the valuation is low enough to justify a buy recommendation for Upstart stock. Even though it has great potential, it could disrupt the entire lending model, which could give it huge upside in the long run. But there's also huge risk with this business in the long run if the AI model doesn't progress or doesn't compare as well to the traditional lending model. So I think this is a business that you can afford to wait for the earnings to come out, evaluate the results, and then make a decision after the company reports earnings. Of course, you run the risk of missing out on a huge increase following the earnings results, but that's okay. It's not like if the company's stock price goes up by 30%, then you've missed out and you can never buy Upstart stock again. You can still buy Upstart stock even if it's 30% higher and still be getting a better value buying it after earnings than buying it before, because you have new information now that justifies the higher price, and it could be an even better value at the higher price. Once you incorporate that newer information, you're getting perhaps a lower risk business. And of course, if risk is lower, price is okay to be higher. So for now, I would say hold off, wait before buying Upstart stock. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.